Well, hello and welcome to today's video, which is going to be looking at some of the estate planning features in Voyant AdviserGo. So I've got an existing plan that I've pre-built for David and Maria Branscore. Their names are up at the top right hand side of the screen. And just for those of you who may be quite new to AdviserGo, do remember to turn on inline help. So click the person at top right, click preferences, and make sure that inline help is switched to yes. Then close that down and we'll see how inline help works as we go through. First of all, if you're going to be doing some IHT planning for clients, there are one or two things that you need to think about when you're setting up the plan. The first thing I'm going to do on the dashboard screen is come down to the bottom to my plan settings and check under my inflation and growth section what assumptions I want to make about future escalation for nil rate band and the property threshold. Now we have hard coded in the changes in the March 21 budget, which mean that these are frozen through until 2026. But beyond 2026, I'm going to use 1% per annum as my escalation rate for the nil rate band and for the property threshold. So just be aware of that. Something else that I need to check on my dashboard, if I've already been doing some IHT planning for the clients and they may have made pets within the last 7 years, come into the carryover assumptions section and scroll down to the nil rate band carry forward and previous pets section. If they have, for example, inherited nil rate band from a deceased spouse, you can factor this in here and the resident's nil rate band. If they didn't use their annual gift exemption last year, you can put in the £3,000 there so that they could potentially make gifts of up to £6,000 this year. And if they've made previous pets within the last 7 years, click to factor those into the plan so that when the software does its IHT calculations, it can account for those previous pets. So let's just click done. Now these clients, if we look underneath the chart at the top of the dashboard screen, are already in their 70s. They're planning ahead, they're quite wealthy. If I change the widget here, and let's look at their assets by type. They've got money, net worth of about 2.152 million. They've got money tied up in their property. They've got some money in cash and non-pension assets, and they've got some money in their pension fund. And what they're keen to do is assess whether they do have a potential IHT liability and how they might go about mitigating that, because they would like to potentially give some money away to younger generations of the family if they have the ability to do so. And in fact, I've already modelled in one of those gifts, and I've added in an expense, which is a legacy gift. And the legacy gift feature, the legacy expense, means that anything that I enter as a legacy expense will be treated as a potentially exempt transfer for IHT purposes. So here I've just set up a one-off gift, quite a small gift from David to the granddaughter, so £20,000. And of course I've set the priority for that, I've set the timing for that, and I did have an event on my timeline which was for the purposes of giving money away to the granddaughter. Okay, so we've established that they're quite wealthy currently, and looking at their cash flow chart, it's resolutely blue all the way through to 100. They don't appear to be having any issues with shortfall. They can meet all of their spending needs. And again, if I were to put the details onto that, I would be able to see what they're spending. And currently we're spending, if I put the key on by clicking the 3 grey dots on the right hand side, they've got their state pension and their DB income coming in. They're then taking some withdrawals from David's drawdown policy, and the software is then topping up to give them the level of money they need to meet all of their expenses, just by taking ad hoc withdrawals on an as needed basis from their savings and investments, which is what we're seeing in blue. So if the question is, do we have a potential IHT liability, we can answer that by clicking on the Legacy tab up at the top. And the first screen that I will see is the planned legacy. So it assumes they both live to default mortality, which is 100 in this plan. David is the older of the two and he dies first, leaving everything to Maria. And it's a gift between spouses, transfer of money between spouses, so there's no IHT liability. Maria dies a couple of years later, leaving an estate valued at about 2.7 million. That goes to people outside of the plan, and we see a potential tax liability being highlighted of about 565,000. If I want to see the details, click on the dots and dashes button here. And you can expand each section to see who is leaving what. So if we click into savings and investments for David, he is leaving money in his ISA. He's also got his share of the property. So on the right hand side, we see his 50% share. On the left hand side, we see the total value of the property because it's jointly owned. Scroll down and keep scrolling down to see the position when Maria dies. What has she got left in her estate? In terms of liquid assets, she's got the value of her cash ISA and her investment ISA. She's also got the full value of the property at that point in time because she's inherited David's share. So total estate value of about 2.7 million. Scroll down to see how we're going to calculate the IHT. The standard nil rate band by that point has inflated. Remember, I had escalated it by 1% per annum. So it's then valued at 405,000. And she's got IHT carryover from David of 100%. So we can double up the nil rate band because he didn't use his on his death. There's also some main residence exemption. Once again, you can see we escalated the estate threshold. And so we're factoring that in as well to give her a total nil rate band of nearly 1.3 million. But of course, after deducting that from the value of the estate, there is a taxable estate and we're charging tax at 40% on that to arrive at the inheritance tax figure. So that's the position as it stands now. The other way that I could look at their potential IHT liability, if I want to look at it for every year in the plan, is to click Insights. And there is a potential IHT Insight. Now this is where inline help is your friend. If you click the I symbol, the inline help box pops out and explains to you briefly what the inheritance tax Insight does. You can click to read more about it. If you still have questions, click the help button and click the email address so that you can send an email question into the support desk. To run the insight itself, click on the name of the insight and click Get Started down at the bottom. So this is the potential IHT liability for every year in the plan, based on the assumptions that we've factored in. And the red line is showing you the potential IHT liability. So if you hover over any year, the box will pop up, give you the projected IHT liability, and it's overlain on the net worth chart. You can change the chart if you'd like to. You could, for example, use the assets chart to see what assets they're left with in the plan. If you want to focus on the IHT liability itself, you can click Hide All and then just put the line on the chart, which for those of you who, oops, I've clicked the wrong thing there. For those of you who may be used to using Voyant Advisor, you'll be used to just seeing the line on the chart when you're looking at the IHT simulation. So we can see that IHT liability is creeping up over time and then staying fairly level, maybe just disappearing slightly towards the end of the plan. So we do have a potential IHT liability if they live to 100. What about today? Click back on the Legacy tab. And as well as the planned legacy view, you've got the option to look at if David died today but Maria lived to planned mortality, vice versa, or if both die today. Now, do appreciate that when we say today, we actually mean at the end of year one. So we've had a year's growth on our assets And if we scroll down, we'll see that then David is dying in a year's time in 2022. And we do still have an IHT liability there. So they have an issue with IHT. What are we going to do about it? Let's go back to the Let's See chart. And I'm going to put the dual chart view on to begin with. And I'm going to compare their cash flow in the top with their asset position on the bottom chart. The cash flow tells me whether they've got enough assets to meet their expenses. There's no red in it, so no shortfalls, so they can easily cover their projected expenditure. It also shows me, when I've got the detailed view turned on, where the money is coming from, again, particularly if I put the legend on. The assets chart is showing me what assets we're left with in any year of the plan. And again, if I hover over the final year in the plan, remember we were left with money in an ISA, in savings, and the value of the property. Now, this plan is not particularly efficient from an IHT planning perspective. The thing that I would be thinking about here is they've got quite a bit of money in pensions. Would it be better to defer taking the pensions for as long as possible in order perhaps to have a little bit more of an IHT efficient plan? Let's see whether we can do that. And I'm going to click What If and create a What If plan. And we'll go call this Preserve Pension. Click Create this plan. Now at the moment I have got planned withdrawals set up to take money from the drawdown pot, because that's what David has been doing so far. But let's turn those off. So if I come down to the planned withdrawals section, into that planned withdrawal where we're taking 36,000 a year from his pension, and we'll just bin that, delete it. Now let's have a look at how the cash flow changes. The colours have changed now. And if I put the legend back on, for those of you who may not be familiar with the colours, we now only appear to be drawing on the pension right at the end of the plan, because they've got sufficient other non-pension assets in this plan to cover off their spending needs during their lifetime. What impact might that have had on their IHT position? Let's click the Legacy tab again. And now that we've got a what if in the plan, we can do a comparison view. And what I'm going to do on the left-hand side is switch back to my base plan. And on the right-hand side, I'm going to have my Preserve Pension, the one where we've deferred taking the pension for as long as possible. And we can scroll down and see the difference in potential IHT liability. In the base plan, where we had lots of ISA money left, we've got a tax liability of about 565,000. We still have a tax liability in the one where we've preserved the pension, but it's much reduced. Let's put the details on and see why that is. And I'm going to click the details on each side. But we're going to focus on this Preserve Pension on the right-hand side. So if David dies first, and if I click into savings and investments, what's he leaving on his death? Well, he's leaving the value of his drawdown fund. We haven't need to touch it up until this point in this version of the plan, so it's just sat there growing, and he's now got over £1 million in his pension, which he can pass on to Maria as an inherited drawdown. And of course, he's got his share of the property. Scroll on down to see what happens when Maria dies. What has she got left? She's got the remaining value of the inherited drawdown, and again she can pass that on outside of her estate. The property will still form part of the estate. So if we scroll on down, she does have some nil rate band that she can offset against the value of the property. So there's still some IHT to pay, but of course we can then pass on the value of the pension, just over £1 million, and so our net worth after tax is significantly greater. Because we've preserved the pension, we're passing on 2.75 million instead of 2.14 million. And that was just by adjusting the order in which we used their liquid assets, because these clients had a good spread of liquid assets. If we wanted to take this a little bit further, we could look at the insights again. Come down to the Potential IHT Insight. And again, this time we can now do a comparison plan. So I'm in my preserved pension and I'm going to compare it with my base plan. And click Get Started. Now this time, there should be two lines that appear when the insight has completed its calculations. One will represent the projected IHT liability in my preserved pension plan, and the other one will represent the projected IHT liability in my base plan. And you can see they're in red and purple. The little key is up at the top, and if I hover over any year, again, I can see the difference. And the red line, which is the projected IHT liability for the plan that I'm working in now, preserved pension, is lower, and progressively the difference between the two increases over time. Again, if I wanted to just focus on the lines on the chart rather than the chart behind it, if I click Hide All and then just click to bring back the graphical representations, I can see that difference perhaps a little bit more clearly here. And of course, I can print this out into a report by including the estate analysis section of the report. There's another feature that might be quite useful for these clients. If we look at their Let's See chart, and again, let's put the dual chart view on. I'm going to switch the top chart to cash flow again. They can cover all of their expenses, the cash flow tells me that, but they've still got money left at the end of the plan, although it is very tax efficiently from an IHT planning point of view, left in the form of pension. But what they'd like to know is, could they afford to give away more money now? And it looks as if they could do if they want to. How might we go about assessing how much they could give away? Let's click on the Insights section again. There's another new insight in AdviserGo that can be useful for having a discussion around this. And this is the loss capacity insight. Let's click on loss capacity. And I'm going to click Get Started. And this is going to calculate the maximum loss the clients could accept at the start of the plan and yet still be okay in terms of meeting their planned expenditure. And it gives you a loss rate in percentage terms, and that's the loss that could be sustained from their invested assets, and it translates that into monetary terms. And to understand what the insight's doing, if I just switch the chart view to assets, it's telling me that if we did have a loss of invested assets in year one, but in subsequent years we return to our standard growth rates, then all other things being equal, they would have sufficient money to meet all of their expenses, but they would have spent down all of their liquid assets by the very final year in the plan. And I can turn this around a little bit and think, well, in effect, if all other things stay equal, that loss amount is probably the maximum they could afford to give away. Now, you would never give away all of it. You would want to leave a safety sort of buffer, if you like, but it's giving them an indication of how much potentially they could afford to give away. And so what we could perhaps do is start to give away some more money. And if we say we're going to do a what if here, where we'll preserve pension and start gifting. Just to show you how I would do this. Now that I'm in my what if, I can add in some gifts. And I'm going to click the plus button to add some expenses. And they're going to be legacy expenses. And first of all, I'm going to set up some annual exempt gifts in actual fact, and we'll call this David's AEGs, and we're going to give away £3,000 per annum, not 30,000. I'm going to set that inflation rate to 0. I don't think they've ever changed that, and it's not a top priority. I'll move it down the list. It's a sort of luxury in terms of priorities of expenses that are to be met. And I want that to happen from the start of the plan until David's death. So we're going to give away £3,000 per annum. I could then do the same for Maria. But the other thing that I'm going to do is I'm going to add an event. And I'm just going to say give away a lump sum. I'll just choose a nice little icon that works for that. Let's say they're going to do that maybe in about 2 or 3 years' time. So I've added a point in time. Now I'm going to add another expense. It's going to be a legacy expense, and let's give away, let's say 150,000 at that point in time. And I can just say it's going to happen, oops, at that point in time there, set it as the start event. And I only want it to be a one-off, so I'm also going to set that as the end event. It's just going to happen in 1 year. And let's click done. And what I should see on the dashboard is that my chart should change. And if I want to check exactly what's going on, come to Year View and come to Expenses. Now remember, I'd set up the legacy gift to happen every year for David, and so I can see that as I move the slider along. And then I've got this one-off expense as a lump sum, and it has inflated that expense. You could choose when you added that expense whether or not you wanted to inflate it between now and the date at which it happened. So that's one way that I could give away money. The other way that I could give away some money is perhaps to move some money into trust. And if we click the plus button, come to Savings and Investments, and we'll have an investment. And let's have it jointly owned. New trust. And you can choose from a range of tax wrappers when you select the type box. Let's set other trusts. There's no money in there as yet. I'm going to move money into it. I need to choose the structure, and that will determine whether it's treated as a pet or a chargeable lifetime transfer. So I'm going to select it as a discretionary trust. When am I going to set that to happen? We'll set that in a moment when we set up the transfer. So you add the empty trust first by clicking Done. So I've got the trust wrapper into the plan. If I come down into the Savings and Investments section on the dashboard now, I can click back into that new trust and I can set up a transfer into it. And click to add a transfer, and we'll transfer into this account. I want it to come from their joint savings account. And again, I can just put in a specific amount. Let's put in £100,000. It's not going to be recurring, it's literally going to be a one-off transfer, and I'm going to set that up to happen from the start of the plan. Let's click Done to save that transfer, and Done to save the change to the trust. Let the chart redraw. And again, let's click on Year View to see what's happened. Come to the first year in the plan and come first of all to cash flow, and you'll see although it's not displayed on the chart, I have got a transfer from the joint savings into the new trust. If I come to the investments tab here, I should see money going into the new trust. It looks as if, in fact, I haven't got enough to make that £100,000 transfer. I think in this year, in fact, the cash is being used for other things. So they're spending it. So I've overestimated how much I could afford to move in because I had put or had not moved the money before paying expenses. So that's why it hasn't done the full £100,000. Come back to the legacy screen just to see the impact of this. And come to the if both die today, so at the end of year 1. Just expand that screen. So this is David dying in 2022. And you will see that we've started to highlight up the legacy gifts, the annual exempt gifts and the transfer into the new trust. So we are accounting for those. So having set up our plan, it might be time to generate a report. And of course you could choose whatever you wanted to include. I'd usually include the financial summary, the assumptions, maybe the events and goals, maybe the fact find. And I can put in the estate analysis. Let's add all of that to the report. And I'm just doing this for example's sake from this preserved pension and start gifting, but I can choose any of my various plans from which to do that. Again, I can customize the summary. We're not talking about life insurance needs here, so I'm going to untick that. I'll probably include my cash flow detail chart. I'm going to move my assumptions to the bottom and my fact find. And again, I can customize what I want to include in the estate analysis, and I can include or exclude the details for the planned legacy and both die today. So let's toggle those off, just to keep it relatively short and simple. Then if I click generate report, we'll see what the report looks like. This does just take a little bit longer than we may used to, but here it is, and it's downloaded on the left hand side of my screen. Client's name on the front and the date that it was prepared and your name and address. The financial summary, which may be new to you if you've not used AdviserGo before, just with a snapshot of the net worth, where the assets are held, the cash flow detailed chart, and now of course that we've given more money away up front, we're having to spend our pension earlier on in the plan, and just some general information about what's our required rate of return and how much they could afford to spend. And here's our estate analysis. So we've kept it quite nice and simple to show them what the potential IHT liability is. Even after the gifting, they do still have some IHT liability because of the value of their property in this plan. And we've got the if both to die today situation as well. So all of that's in there. And that was a very high level introduction to estate planning in Voyant AdviserGo. If you have a particular plan that you're working on, do remember that you can contact us for help and we can run a one-to-one screen share with you looking at your plan and helping you model whatever advice you want to give so that you can show the client the benefit of your advice with regards to saving them inheritance tax. Thank you for watching today. Watch out for our other videos.